Welcome to this evening's webinar, Creating Your Own Personalized Wealth Plan with PRISM, led by Charles Rotblut. I just want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you to make your own decisions. A handout of the presentation is available under the Handouts panel of your GoToWebinar control panel located on the right-hand side of the screen. If you have questions for our speaker, please submit them using the Questions panel of your GoToWebinar control panel. Our moderator will select questions submitted and read them aloud for the benefit of all watching the broadcast. Questions that are not selected for the broadcast will be reviewed and addressed afterwards. If you experience any issues with audio or video of the webinar, please consult the instructions on how to change your device settings or consult the GoToWebinar website for support at gotowebinar.com. Reminder that this presentation is being recorded and a replay of the presentation will be available tomorrow on AAII's YouTube channel, along with the links to this evening's handouts and some of the resources discussed. These links will be sent to your email address. Links to some of the resources discussed will be sent to your email address tomorrow. AAII's mission statement. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. Now please sit back, relax, and enjoy this live presentation. Take it away, John and Charles.
Oh, thank you very much, Kyler. My name is John Bykowski. I'm president of the American Association of Individual Investors, and joining me tonight is Charles Rotblut. Welcome, Charles.
Good evening, John.
We weren't sure for a moment if you'd make it here tonight. We had a little technical difficulties leading up to the very last minute, but we're all glad you're here. And if there's a little bit of lag, it's Charles has called in for you, I think, his cell phone tonight. So cross your fingers that Verizon is going to be a strong provider for us tonight.
Using a little bit of MacGyver techniques tonight. We got it going.
I'm impressed, Charles. And Russell, glad to hear you're healing very well. Charles had a minor accident a few months ago, but he's back in the saddle again, and he's able to type with both hands, and he's able to produce material for us. You folks, of course, know Charles as the editor of the AAII Journal and also as the lead analyst for the VMQ stock service. But tonight, Charles is going to be giving us a special look, a special sharp PRISM look at the whole process of a systematic way of how we as individual investors should think through the process of planning into the future, building up a asset allocation, determining how we want to manage our portfolio, selecting our securities, in the process of even going ahead and reviewing them over time. So Charles, just a quick hello, quick shout out, and tonight, what should our subscribers expect to see in our webinar tonight?
Well, we're going to show them how they can develop their own personalized investing plan. And really, it's about having a systematic and well-defined approach to investing. And it goes back to what our founder, Jim Cloonan, said, the founder of AAII, about always just really having a systematic, well-defined approach to investing. So if you know the why you're investing, that can drive a lot of your decisions. And if you know why you're investing and you have everything lined up to fit with that why, it really gives you a lot of clarity and gives you a lot of discipline, so you can tune out a lot of the noise that happens on a daily basis and really focus on what's important to you and what's going to help you achieve your goals.
Now, here at the association, we've always preached that there's no one way to invest. There's no one system that works for everybody. And that, is this a one way, or is this simply a framework in which people can have specific preferences? Or let's say they're a value investor, a deep value investor. Let's say they like to index and be low cost, or like to be very specific. Is this reasonable for them to use no matter what your approach is?
Yeah, absolutely. And I like to think about this as a wide road with guardrails. We're going to give you a lot of space to move in between, but we're going to have these guardrails on both sides so that you don't go off kilter, so that you don't lose your place. So plenty of room to move around, a lot of flexibility, a lot of ability to customize it, but you still will be in a spot where we're sending you down a path towards investing success.
Interesting. That's good to know, because again, it's for me, you and I have similar viewpoints in how we pick stocks. We're a little bit different. We're a little bit different life points as well. In terms of having children that are just finished up with college and whatnot, and getting involved. So I mean, everybody has a different perspective, and I'm trying to instill to my daughter, and she was a graduate just a year ago. She's getting started in life. How does one go ahead and plan for the future? And so it sounds like from what you're saying is that no matter what your stage in life, uh, this is a process you should follow. So whether it's for yourself, if you want to introduce someone that this is a systematic way to take a look at where you are now, where you want to go, and kind of develop a roadmap to get there. Is that fair?
Yeah, absolutely. It doesn't matter if you're just starting out or you're retired and you're really thinking about your legacy or somewhere in between. This really is a system set up where we're giving people the tools to create their own plan. And this plan is adaptable regardless of what your life stage is, or even where you are in terms of wealth or where you are in terms of your life. We're really giving you a framework that's going to apply to a broad range of people.
That's kind of what your first slide actually says. I was peeking ahead here, Charles. I know we didn't have a chance to talk ahead of time, but I got the sense that your goal tonight is to kind of walk people through the system. And PRISM is a new name, PRISM, the Wealth Building Process. In the AAII Journal, last year you introduced a number of worksheets that people could use to answer some of these questions, figure out their risk profile, set up a plan. But then also in the journal this year, you've been going through and selectively walking people through the journey process. And even on our website, we have a learn and plan section that has a series of challenges where you do some nice videos. You explain to people the whole process of developing a plan and looking at your risk tolerance. But so PRISM, in a very simple way, is 5 steps, right? It's the whole notion
Yes.
of planning. First step is planning. So you want to take a look and before, and you could have multiple plans. From what is it limited to one plan? Could you have multiple plans? Does it matter? I mean, what's the whole notion of the whole planning process or prioritizing your goals?
Yeah, you can absolutely have multiple goals. And we'll discuss, I'll give you an example today, but certainly a lot of people have more than one goal. And we really built this so you could have different goals. But, if you go into a pie shop, you can't eat every pie. So you have to prioritize. Do I want the cherry pie? Do I want the apple pie? Do I want the peach pie? And then if I have room, which pie do I want afterwards? So this is the same way. We might have several goals that we want to do with we want to achieve with our wealth, but there's only so many things we can do, and we really need to prioritize what is. But to the extent that we do have enough wealth or enough flexibility in our life to perhaps fulfill more than one goal, we actually set this up so you can have those separate goals and separate paths to reach each goal, but you're always aware of what your priority is. So if you have to let one goal go, you have that written down saying that, this is more important than that. So you always make sure that your number one priority is always met, but while still having the ability to perhaps get to the second, third, perhaps even fourth goal if it's feasible to do so.
And that makes sense. I mean, when things are going well and you have a plan, it's very easy to follow your investment process. I think the whole benefit of having a goal and building out, understanding your risk tolerance and building out any kind of asset allocation is when the market isn't smooth and easy, either when it's going down extremely or going, up even. Having a plan in place is some way to kind of keep you even keeled. So PRISM sounds like a new name. A lot of these processes here look familiar. And if I'm not mistaken, I thought I was on this webinar last year with you, sitting in a similar situation. You and I were both on a webinar. We actually had a poll for members, and they were able to pick a name. At the time, I think it was called the AAII Way, and we were contemplating whether or not we should go ahead and rename it the Wealth Building Process. But now you've added an acronym. And just quickly, can you tell us what PRISM stands for?
Sure, absolutely. So this actually will give credit to our marketing, our VP of marketing, Pete, who came up with PRISM, and his idea was to actually have an acronym that was really easy for people to remember, that not only was the name easy, but really applied to the steps. And so as people can see in front of them on the screen, it's very simple. It's prioritizing your goal, recognizing your risk tolerance and allocation, identifying your investment management preferences, selecting your investments, and monitoring your portfolio. So it really is those key 5 steps. And if you just do those 5 steps, you're going to have a plan in place. You're going to be disciplined, and you will likely end up, if you're not achieving your goal, at least getting much closer to it than someone who's trying to invest in a very undisciplined process where they know where they might want to go, but they really are not following a clear path to get there. And the way I like to describe it is, if you're in Tampa and you need to drive to LA, you need to be there, say, in 5 days, you don't want to stop and think about visiting Niagara Falls. You want to go straight across the country. And if you have a map and a plan in place, you can easily do it. But if you start wavering off course and you find yourself in Kentucky and maybe you're somewhere in Colorado, you're not going to get there in 5 days. And so this whole thing with PRISM, if you follow it, you're going to get to where you want. And granted, life happens and things might happen where you have to rearrange your plan, but at least you'll be on the path to at least make progress to your goals, and you will achieve them provided unexpected events do not occur.
So I know how you travel, Charles, and I know you like to check out local features like the biggest ball of string or something like that. So even what this, I guess, having a plan. So if you have any kind of waysides or any special trips you want to take, you know it's going to take longer. You know it's going to have the extra planning involved, and then you could plan accordingly. That's the whole notion, right?
Yeah, and absolutely, or at least allow the flexibility to do those things. And John's right. So if there's a touristy stop along the road, I'm stopping.
I guess your goal tonight, you're going to give us a little bit of deeper dive on each of these factors going forward. But sometimes to understand these concepts, you're actually going to give us. I have a hypothetical person kind of walk us through the process for that person, for that couple.
Yeah, absolutely. So we have a hypothetical retired couple. We'll call them Bob and Jane. And just to give people a simple storyline that they can follow and see how this plays out, I thought it would be easy for people if we just actually use this couple. And so they're recently retired. They're affluent. They have about $1.5 million in savings. They're also very fortunate because not only do they have Social Security, they also have pension benefits. So their retirement expenses are actually covered by that guaranteed source of income. So they're very fortunate. They also have kids, and they also have 2 grandkids. And when we discuss the PRISM, those grandkids will actually play an integral role, an important role in terms of how their plan plays out and why they're investing.
And did you draw those figures, Charles?
I did. Can't claim much for my artist skills, but I'm decent with stick figures.
You and Marnie look like a nice couple there. I'm sorry, Bob and Jane do. I'm sorry. I got that wrong. So step number 1 is
I should put a bow tie.
So step 1 is prioritizing your goals. So that's really the first step in the whole process. It's really looking, before you can determine what you're going to do, you have to figure out where you're going to go. And so tell us a little bit about prioritizing.
Sure, absolutely. And so goals really are, it gets down to, why is money important to you? Why are you investing? All of us have a reason, and granted, having money's nice, and having a lot of money makes life easier, but chances are there's something we want. And it's probably not just being wealthy, it's probably something we want to do with our money. So if you have a why as to why you're doing something, it actually makes you more disciplined. It makes you more willing to get engaged and do things in a systematic manner. So we really want people to think, why are they investing? Again, why is money important? Is it you want to fund retirements? Perhaps you want a new house. Maybe you want to leave a legacy for your heirs, or perhaps charity or your congregation matters a lot to you. Or maybe it's a combination of things. It really doesn't matter to this discussion why money is important to you, but we really want you to think about it. And if you know what you want to do with your money, then then that gives you the ability to start prioritizing. Okay, maybe you have multiple goals. And so the question is, which goal should come first and which goal should come second? And as I said earlier, if you're walking to a pie shop and you can only have so many slices of pie, well, what slice of pie is most important to you? Is it the peach? Perhaps you like blackberry. So again, you want to prioritize. If you cannot eat every slice of pie, which ones do you want to try first? And when you think about goals, it's not just what you want to prioritize, but then, well, how expensive is that goal? Perhaps you're the person who just bid on Jeff Bezos' spaceship and you wanted to get the right on it. I think that went for about $5 million or so. So that's a lot of money. So the question is, if you're willing to spend $5 million on that, do you have to give up something else? Or did that person have to give up something else? I'm assuming not, but those type of decisions, if one goal is really important and it requires a large outlay of cash, that might mean you have to give up something else. But it's also not just how much do you outlay, but trying to think with that goal, how long is that goal going to last? And relative to your overall wealth, how much are you going to spend fulfilling that goal? I'll give an example. Climbing season at Mount Everest just ended. To go there, the numbers I've seen are about $75,000 to $100,000. Again, a pretty large sum. For some people, that's their life goal, and they're willing to sacrifice a lot to actually take the chance on trying to reach the summit of Mount Everest. For other people, they look at it and they might think, I like climbing mountains, but I can think of a lot of other things I want to do with that money. So those type of things you want to consider. And again, when it comes to spending, is it a small outlay of your wealth, or is it a large amount of your wealth you're spending? Because that actually applies into your risk tolerance and how you're going to invest. So let's look at Bob and Jane.
Before we continue, Charles, our members are reminding us that it actually was not 5 million, but 26 million to go out to space.
Oh my gosh, it was way off. So,
but that's that's the thing.
Evidently, I didn't.
So a lot of us just want this goal of making as much money as possible. Why is that not good enough? Why should we go ahead and actually write down more specifically what we want to do? And here, I guess you have some examples, and maybe you could talk us through why it's so important to actually specify not only how much you want to save, when you want to use it, and over what duration you might actually withdraw funds.
Sure, and so right, a lot of people want money, but again, the question is, well, why do you want money? Do you just want to have the ability to perhaps, pay for a space flight with Jeff Bezos? Maybe it's something else. Chances are there's always a reason why people want a lot of money. What are you hoping to do with it? And maybe it's financial freedom. Maybe your goal is to really have enough money. So to quote that old song where you could tell your employer, take this job and shove it. Maybe, and financial freedom is a goal. But then if that is your goal, then how much is enough? How much money do you need to feel like you have enough financial freedom to do whatever you feel like on a daily basis? And that can be a goal, but the idea is whatever it is, you have that purpose in mind. And I was recently asked in social media, someone said, well, you have these goals in this financial plan, but you need money to achieve those plans. And I responded, well, if a certain goal is really important to you, and it's really one thing that really matters to you, then you'll probably make decisions with your spending along that line as well. I have a friend of mine who's a financial planner, and he said one of his clients really likes to travel, and he's willing to give up a lot of things so that he can travel. So not only we're talking about from an investment standpoint, but it does affect your spending as well. And so we're giving some examples here. For Bob and Jane, like a lot of people, their first goal is just simply funding retirement. They recently retired, and they don't want to get to their late ages and be out of money. They want to make sure they have enough cash flow that they can live comfortably. If they incur medical expenses later in life, they have the ability to take care of it. So for a lot of people, that is their goal. In this case, we're assuming Bob and Jane are affluent enough that goal's covered. In this case, they're thinking, well, let's help our grandkids. We really want to help out our grandkids go to college. And that's what their attitude is. That's what they want to do. So that's really important to them. Now, somebody else might have a vastly different goal. It might be saving the rainforest. It might be traveling the world. Again, it's really personal and what really matters to you. And when you have that personal drive, I think it does empower you. It really makes things more tangible for you, and it really gives you the why as to what you're doing, why you're doing certain things. And the other reason is that if you understand why your goals are important, then it starts driving other matters in your portfolio, such as risk tolerance and allocation. And John, before I go on, do we have any questions or anything I need to address?
At this point in time, no. Just some feedback. But again, I'm monitoring the questions section for Charles. So if any questions come up, feel free to type them into the questions section. Also, as a reminder, we are recording this session, so tomorrow we'll send out an email with a link to the session, so you can go ahead and review it. And you can also download a handout to see all these wonderful slides that Charles has put together, and you can see some of his drawings along the way. So that would be another bonus to downloading the presentation tonight. So what you're saying then is when you have your particular goals in mind, for example, you have 30 years to go, and you know that you want to plan for some activity. I guess the next function comes into risk assessment, and that's what you can talk about. That's really the R part. It's doing a risk assessment, and from the risk assessment, you're kind of build an asset allocation. So why don't you talk a little bit about that?
Sure, absolutely. And so we tie these together because risk really drives allocation. And so risk is really not only volatility in the market, and a lot of people like to think about risk in terms of how much is the market swinging one direction or the other. Obviously, today we had a Fed meeting. There's always a reaction right after it. But Jim Cloonan used to like to call that type of risk a phantom risk. For the long-term investor, volatility really creates opportunities, and it really is a distraction. But risk, in our standpoint, though, it does play a role in investment goals. If you're nearing retirement, that volatility can play a role because if you have a sudden drop in your wealth right before you're about to retire, that can affect how much you have to live on. So there is a timing aspect, but risk can also, play in terms of your financial ability. I talked a little while ago about how much do you need to spend relative to your wealth. The less you need to spend relative to your wealth on the goal, the more volatility in the financial markets you can withstand, the more swings. So for the long-term investor, volatility is a phantom risk. But for the investor with a short-term goal or a goal that's coming forward or has cash outflows in the very near term, or perhaps even the next couple of years, then volatility actually stops being a phantom risk and really becomes a sequence risk, meaning whether you have a period of good returns or bad returns. But there's also the psychological aspect. And I do have this discussion with a lot of AI members who write to me and say, why should I not be focused on simply return? Why should my only focus be on maximizing return? And to the people who have the ability to withstand the volatility in the markets and they have a long enough time horizon, I absolutely agree with them. Return really matters. But a lot of people, when they see downward moves in the market, like we had last March when we had that very fast but rapid bear market, that really frayed a lot of people's nerves. And so you really have to consider what's your psychological ability to deal with these swings in the market, and also what's your time horizon. If you're planning to buy a house in the next couple of years, then again, the short-term movement in the market's a big risk. If you're age 25 and you're saving for retirement and you're not planning on retiring to age 65 or 70, those downward drops in the market are not risk. That's an opportunity to try and put more savings in. So it really shifts depending on who you are, what your time horizon is, what your psychological ability is, and your goals. And so there's a lot of moving parts defining risk. but once you're able to define what your risk is, then that determines your allocation. What's your ability to withstand volatility? What's your ability to let money ride out over the long term? And keep in mind, when we talk about risk, we're doing a lot of short-term and long-term here, but realize in financial terms, we're talking about sequence of risk. What's your ability to handle a bad sequence of returns over a short period of time versus how much is longevity risk, meaning the risk of you outliving your money? How big a risk is inflation risk, being that the ability of losing purchasing power? All those terms fly in, and I realize it's a lot of terminology at once.
There are a lot of
but
terms.
The big thing is,
Charles, one of the things you did, I think, and you had a great article covering the whole risk profile. I believe it was in the March edition of the AAII Journal, where you actually went through and you gave members a kind of a rundown, all the different kinds of risk. So, like, I think from what I recall, I think in the January edition of the journal went into the whole notion of the planning part. And then in the March, you talked about, I'm sorry, the February, you talked about really about, strike that, the March, you talked about the risk part of it. And one of my favorite things in the risk thing was that, there's one of the elements I think you define as risk is not achieving the rate of return you should have, given the risk you took. And, there's different ways to do that. But one way to possibly, you're going to fall short of what your return should be is by simply selling at the wrong time when the market's down. So, there's different kinds of risk. And I thought you really did a great job in the March edition of this article. So members, is this all in the learn and plan area, or should just simply go to the AAII Journal part of our website to see those articles?
It's actually probably the best place to go to AAII Journal. We're actually building out our learn and plan area, and we're actually going to create an education hub. So we'll actually be able to link to all that stuff through that as well. But we'll put in the show notes as well the links right to those articles so people can actually get to them directly.
And then you also created some last year some worksheets, and I think your next slide gives us a risk assessment worksheet.
Yeah, absolutely. So this actually was in the journal. It's available on our learn and plan page, and so we're talking about risk and these different types of risk, and this allows you to help assess it. And so you can see there's two parts to this. There's a timing of goal and a financial and psychological risk. And we chose these because the timing of the goal, again, goes to what I was talking about in terms of sequence of returns, longevity, inflation. It really is three things. How far in the future is your goal? A short-term goal where I want to buy a house in, say, 2 years, that means you need it to have a very conservative approach. You know what, I won't need this money for 30 years. You got a lot of time. But also see on here where we start talking about the timing of the goal. Are you looking, say, at a lump sum spending where you're going to spend it all on once? Or is it a long period? And so for retirement, when you get to retirement, it's important to realize that you might retire at age 65 or 70, but if you have good health, good genes, you can be looking at 25 or 30 years or longer of being retired. So you could have this, you do have this set period where you're retiring, but your goal could have this long tail to it. So that plays into it. As we said on the financial and psychological side, it comes down to your ability to withstand drops in the market. I do want to point out here that we did specifically write, what did you do during past drops in the market? And the reason we wrote the question that way is a lot of these risk questionnaires you might see advisors give, they give examples. What if you had a portfolio and it lost 25% of its value? What would you do? The big problem with that question, the way it's worded, is your mood that day will depend on how you answer. So if it's sunny outside, if it's cloudy, if the market's up, if you're happy with Jay Powell's decision, if you're upset, those type of things will affect that answer. And if you see those questions, realize you might answer it one way one day, and you might answer it completely differently on another day. So we're actually encouraging you to go back and look to records and look at those past times of market turbulence when we had those bear markets and see what you actually did, because that might be more predictive of what you do in the future.
So I've got a member question who's asking,
sure.
was last year's bear market, was that a good signal or a good test of risk tolerance?
I think I think any bear market's a good signal of it. If you have the records going back to 2008, I would look at those as well. And it's probably good if you have look over a few times where you have market drops. That's actually better than just one time, especially because that bear market was so quick. But if you did notice that you panicked, then that might be a sign that you might have a tendency to do it again in the future. And obviously people can learn, people can adapt, but it's still a warning sign to know that that is your tendency.
So can you tell us about Bob and Jane's risk tolerance?
Yeah, absolutely. And I just want to cover real quick, because I'm going to get to it. So when you look at your spending needs, we're also looking about how much of your outcome's flowing out, how much of your goals covered by spending needs, because if you can pay for your goals with guaranteed income, that covers more of it. And then also just your knowledge. And we put knowledge in there because if you understand what's normal and what's abnormal for the market, it might make you less reactive. So when we're talking about Bob and Jane's risk tolerance, as we said, their goal they're going to focus on is their grandkids' education because they have the retirement spending covered. And so in this scenario, if the grandkids are young, they have a long-term time horizon. So if the kids are young, plenty of years before college, but then again, they have a very short span to spend it over. So initially, they can take more risk and be more aggressive, but as college nears, they need to change their tolerance. And we're going to assume that they're not going to foot the whole bill for, say, Harvard or Princeton. They're just going to help out. So relative to their wealth, it won't be a huge sum of money going out. That gives them more tolerance. But we'll assume that in the past they have panicked. They get a little bit wary when the market starts fluctuating, so their psychological tolerance isn't as high. And all the spending is going to come out of their savings. So given this, we're actually going to say that, they can maybe be aggressive, but their psychological tolerance might want them to go a little bit more conservative. And the reason why is in their scenario, it's long-term because inflation matters more than volatility. But they are paying on their portfolio, and they do have this tendency where they've previously got a little bit worried about what's going on in the market.
So if their grandchildren were older, how would that change their risk tolerance?
And that's a great question. Because right now we're going to assume they're doing the aggressive tolerance. But let's say their eldest grandkid was, say, instead of being 8, say he was 16. Then they would have to start thinking about transitioning because they know obviously they'll need some for the short term. 2 years will be cash outlay. And maybe their grandkid will get through in 4 years. Maybe a little bit longer, but they know they're looking at this 4-year plan, so they need to start to actually tailoring it. And this isn't much different than someone who's retiring, where they know they're going to have a short-term outlay coming up. And even Jim Cloonan in his book Level 3, who pitched a very aggressive very aggressive allocation, he even talked about as you start nearing retirement, having a safe bucket of assets of 2 to 4 years of expenses to cover that short-term spending. So Bob and Jane, as their kids near college, they go from being aggressive to maybe a moderate to conservative as college approaches, so that money's not being put at risk in the markets. John, any additional questions we have before we move on?
Asset allocation, Jane asks if I've recently heard a well-known financial planner say that $300,000 should be set aside in retirement just to cover medical expenses for the typical retiree. If that's true, let's say you want to set aside $300,000, what kind of asset allocation should be used for that?
Yeah, that's interesting. I've seen various numbers thrown around for medical expenses. And it's tough to allocate.
The key, I guess, here is that this is money that you might be able to, you don't know when you're going to need it, right? So you know how much you might need, but you don't know when you're going to need it.
Right. And so that's the thing where you might want to actually think about splitting up, having some shorter term in case you need it, but some longer term as well, because, if you're looking at things where you maybe need assistance, maybe you need memory care, that could happen later in life. And so you have a huge expense, but you don't incur it till later. So it's you want to think about probably, having that shorter long-term mixture, but you also want to think about, are you prone perhaps to memory loss? You're prone to something that might actually impair your mental capabilities. And that issue, you may also want to think about not only how are you going to allocate it, but do I also need to have a plan in place to maybe where I need a money manager, or I need to start vetting, say, personal advisors, or let my family members start training them to take over in case that's my risk. So there's a lot of moving parts to it. But yeah, you want to think about short term having some very liquid, but also perhaps if it's going to be a later in life scenario and you're still early in retirement, then maybe aggressive to grow it over time.
One more question, and I'm not sure if I understand the question, but maybe you do. What is the difference between an asset class and an asset class group?
That's a great question. And if you look to our mutual fund screeners, our ETF screeners, or even our mutual fund guide and ETF guide, you'll see those terms. So an asset class are really your big groups. So your equities, your fixed income, your bonds, your cash, commodities. An asset class group is really a subset of an asset class. So within stocks, we have large cap, we have small cap, we have developed nations. When you look at fixed income, we have corporate, treasury, long-term, short-term. So asset class groups are really those smaller, really subsets of the asset class groups. So you can see here, we have a large percentage here to equities, but we're telling people on an asset class group level, say for aggressive, put 20% in large cap groups, large cap stocks. So it really is, asset class groups are a subset of the broader asset classes.
And one more question before you go on to the next section. How did you arrive at how much to invest in domestic versus international stocks?
Sure. So this is a great question. And John, you can obviously fill in on this as well. This is actually a long-term allocation model that we've had here at AAII, and it actually was based on a survey of investing professionals about giving individual investors a framework for investing. And so these different levels are all, we're considering growth, but we're also considering diversification. And over the long term, we know that international stocks do provide some diversification. But this actually was is on a survey of investment professionals, particularly portfolio managers, in terms of giving investors models to base their allocation decisions on.
So, we have this asset allocation now. And I guess the question then comes, okay, so let's say I know I want to put 20% of my money in large cap stocks. What's the next step? I guess it's the investor preferences area, because I guess you as an investor have to decide how active you want to be, because there's different levels. Do you want to manage it directly? Do you want to take a look at handing it over to a financial planner? Do you want to look at stocks? Maybe I want to manage my microcap stock portfolio. So I guess the next section, when you talk about investment management preferences, it really gets into what you as an investor, how much time you have, your interests, your beliefs. Is that once you fill us in on that section?
Yeah, absolutely. And so it is the I in PRISM, but in terms of a goal, it really, again, is the I and the person who has this plan. And it really is, how is your money going to be managed? For instance, you might be someone who loves rolling up your sleeves and picking stocks and perhaps analyzing bonds. Alternatively, if we were doing this, in person, the person sitting next to you might be someone who really just wants to hire funds and have the fund manager make those decisions for them. Someone else in the room might want to have an advisor. So it really comes down to, when you're thinking about the individual securities that are going to make up your portfolio, not thinking about the funds, but the actual stocks and bonds, who's going to pick them and who's going to decide when they're bought or sold? And there's a lot of preferences here. One is your ability to do so. One is your time. One is your interest level. But you could also have constraints. You might envision yourself as someone who does all the research on stocks, but Perhaps you're with a 401k plan, or perhaps you're working and your employer places constraints on you, so you're forced to hold mutual funds or ETFs. Alternatively, maybe you don't have the time you need to research investments. And obviously, you could be the complete opposite end, where you have the time, you have the interest, you have the knowledge to pick individual investments. And certainly, some people just need assistance. Maybe they need an expert to provide them tax guidance, or perhaps they actually take comfort in having a financial planner or a personal financial advisor they can talk to and get feedback on how they're doing and help with executing their plan. So this really comes down to, how are the securities that are going to actually comprise your portfolio, how are they going to be selected? And we've created a questionnaire here to help people figure out what type of investor they are and what their preferences are. And it really comes down to asking people personal questions about, control. Do they want to have a lot of control over the decision process? Do they have constraints? What's their interest level? Do they have time to do it? And really, when people take this questionnaire, one of the feedback I've gotten from people is say, well, you give us these questions, and we do give you guidance. We really try to think about, and I should back up here, when you take this questionnaire, we actually give you a series of different types of investors. And you can see this on the screen. It goes from being fully hands-on, the person who handpicks everything, to the person that relies on an advisor. And when you pick this questionnaire, we don't say that, if you answer this, give this answer to this question, this answer to this question, that automatically makes you a partially hands-on investor, because we realize there's shades of gray. And so we try to think about, what are the major types of investors out there? And so we do give you a lot of guidance. You can see in the AAII Journal, we'll include it actually was in the May AAII Journal, and we'll include this in the show notes to the link to the article, where we actually give you guidance that what exactly a partially hands-on investor is, what it means to be a fund investor. But realize that not everyone fills into these holes, and there might be certain things that pushes you to one thing or another. But the idea is to have a framework, because if you know what type of investor you are, it narrows down the scope of investments you can have. And let's take a look at Bob and Jane, because this will help crystallize things for people. They're looking at things, and they may want to actually use a 529 plan to save for their grandkids' college. And I do want to point out, before we get questions about college savings, I'm not an expert when it comes to the college, paying for college. So, but grandparents can contribute to a 529 plan. But if they do, that's going to be constrained on them, in that it limits their investment choices. But in this case, they may want to actually put them into being a bolt-on investor as opposed to a fund investor, because even though, say, a company like Brightscope offers a menu of mutual funds, there may be questions regarding financial aid where they want to consult an expert with college financial aid to make sure they don't unintentionally create problems. They may also have concerns about estate planning. Perhaps they were thinking about leaving money to their kids and to their grandkids, and they may, in this case, want to actually bring in an estate attorney as well. So this is what I'm saying. There are some nuances, and you want to think about what considerations do you have that might place constraints or questions you need to solve in terms of what type of investor you are.
And just a couple of questions before you go to your next section
Sure.
here, Charles.
Mm-hmm.
When it comes to advisors, what's the best resources that you want to consider when picking an advisor, and what's a reasonable fee to consider for an advisor?
Sure, absolutely. So in terms of picking an advisor, one of the things I will ask is, do you just need a plan or someone to give you feedback, say, on your asset allocation plan, whether you're just on track to meet your goals, or do you want someone to comprehensively manage your finances? In this case, you might be looking at an advisor. And it's important to realize that there is a difference between an advisor and a planner. They can do different things. A planner will typically work on a fee basis. An advisor might actually work on a percentage of assets under management. It's not uncommon for an advisor to charge 1% or more in terms of your assets they're overseeing. A financial planner might charge an hourly fee. I do not know what the range for that is. But I think when you're doing it, make sure you check things like the website BrokerCheck, which is run by FINRA. The SEC, we'll put a link on our show notes. The SEC has a website where you can check an advisor as well. If they're check an advisor, if they're a planner, it's always good to get referrals. There is a National Association of Fee-Only Planners. These people are more likely to actually just charge fees for the services as opposed to commissions. But you also want to talk to an advisor. Be clear about what you want. Make sure they're a good fit personally. And I always suggest that people get a recommendation, but then if you're considering working with somebody, check with your state regulators and just type their name into Google and see what comes up. See if there's complaints. See if there's things going on with them that make you feel uncomfortable. Hopefully there'll be nothing, but that one time there is something, you'll be glad you spent that 5 minutes looking at that person.
And then again, a couple good article ideas here for you, including coming up with a calculator to look at the opportunity cost of using an advisor and paying 0.5% to 1% a year, or what impact that has over 30 years. So, and even like things like fiduciary. So, this is our, it's a lot of good questions here. We'll try to get to those towards the end of the webinar if we have time. And if not, I'm sure Charles will come up with some good ideas for the journal as far as carving them out. So Bob and Jane, they're going to, the indexing funds, they classify themselves as bolt-on investors. And what's the next step? I guess it's selecting the investments.
Yeah, absolutely. And so we talk about investments. So there's really two ways of picking investments. Most people are really familiar with a bottoms-up approach. We call it the Jim Cramer approach, where you turn on Mad Money, Jim Cramer's hitting this button yelling, buy, buy, buy. And you say, well, Jim Cramer's really bullish on it. Maybe I need to take a look at it. The PRISM approach uses a top-down approach. And we talk about this in this month's, in the current issue of the AAII Journal, which the article's available online. I know I got my June issue in the mail. I believe it was yesterday, or perhaps it was Monday or Saturday. But you'll see an article in it. So a bottom-up approach is really you're just looking for the best investment. A top-down approach is you're starting with your goals, and then you're looking at your risk tolerance, your allocation, your preferences. So you're letting all those steps guide you to the universe. And it's helpful to think about it as a funnel. So there's about 25,000 mutual funds. There's about 2,500 ETFs. There's 5,000 exchange-listed stocks. And then there's thousands of bonds. So you have all those securities you can pick at, you can go through, and maybe you're trying to find that one needle in that huge haystack, or maybe you can actually go through this PRISM funnel where you're actually narrowing it down. Okay, I know what asset class needs. I know what my asset class needs are because I'm using my asset allocation. I know whether or not I'm going to look at stocks or if I'm going to look at funds, and if I'm going to look at mutual funds or ETFs. I know if I'm going to look at actively managed versus passively managed. And all of a sudden, you're taking this whole universe of securities, and you know specifically, I'm going to look for a large cap stock. I'm going to look for a passively managed small cap ETF. Whatever it is, you're narrowing down the universe. So the idea is you're still trying to find a really good investment, but rather than trying to go through the whole universe, you're actually narrowing down the path to where I'm going to look specifically at this asset class group, and within this asset class group, these specific types of investments, and then I'm going to find the best one. And you can even narrow it down more. So say, for instance, your asset allocation need is small cap, but you're a value investor, and you know you want to be an active investor. So all of a sudden, maybe you narrowed it all down to the shadow stock portfolio because you know that's a well-defined, a well-run small cap value portfolio, and you're a small cap value investor who likes to do things themselves, but likes having someone, give a short list of investments you can consider. So that's how this top-down approach works. Instead of trying to look through the whole universe, you're using your plan to actually narrow it down. But I do want to point out that even though you're narrowing it down, you still have to have formal buy and sell rules. And we're going to give you ideas. In fact, over the weekend, I finished an article about mutual funds and ETFs. You'll see that in the July AAII Journal, where I took this PRISM process. I'm actually explaining to you, well, if you have this and you get to the point where you know you want a mutual fund, what are your considerations? So we're going to do that with mutual funds in July. We're going to move on to stocks and to bonds to give you a framework where you can actually create rules. And this goes back to really what Jim Cloonan said, and I mentioned this earlier, about having a well-defined approach to investing. That was his rule number one. And his rule number two was always follow rule number one. So we have a worksheet here. We have these rules, write them down. And I want to point out AAII, all of our model portfolios have pre-written buy and sell rules. Yesterday, John announced changes to the shadow stock portfolio. Those were made according to the rules the shadow stock portfolio uses. So as part of the PRISM process, not only do we want you to write down your path and how you're going to achieve your goals, we want part of that, how you're going to achieve your goals, to be the rules you specifically have for buying and selling investments. So to make this a little tangible, here's Bob and James' process. They're going to match allocation needs to what's offered in the 529 plan. They have a preference for index funds, so they're going to look to see if those are available first. And if not, then they'll have to obviously there'll be constraint, meaning they can't buy index funds. They'll have to consider active funds. They'll look at performance within the category. They'll look at expense ratios. And I do want to point out that if you're looking at mutual funds or ETFs, look at the prospectus and make sure you understand what the fund's doing. So again, the allocation determines what they need to look at. The preferences determines within that broad range of what they need to look at, what they want to look at, and then it's a matter of applying the rules to find the best investment for them. And I do want to point out that if Bob and Jane were going to handpick stocks, it would still be the same process, just that the rules for how they would pick investments would be a little different. So this is where we talked about having the guardrails and the adaptability, is that this is not tied to fund investors. This is not tied to stock investors. We really are designing this so there's a lot of room for people to follow their own personalized paths within this broader PRISM framework.
And then
John,
before you
we move
go on
on,
to the next section, which I guess is monitoring, Glenn is asking whether or not you recommend establishing trading stops as part of your reason to sell. Would that be a rule you might define in advance?
Yeah, I would say if it's part of your strategy, yes. For instance, people that follow William O'Neill's Cansom approach, he has an 8% stop loss. So I think it really depends on, that's a tactical decision. And if you're someone who uses technical analysis or someone who finds comfort in using stops, that definitely applies to it. That would be one of your rules. And obviously with stops, it's really having the discipline to follow those rules. So the short answer is yes.
So tell us about monitoring, because okay, so you've gone ahead, you've got a plan, you have an asset allocation, you figured out how you're going to fill that allocation. The one trouble we always have is selling, which is what the rules help with, and determining when it's time to determine if it to rebalance. And what are the triggers that might make you decide that yes, it's time to take a look at my portfolio and it makes sense to make some changes?
Sure, absolutely. And so we use the term monitoring. I like to refer to it as how are you going to engage with your portfolio when you look at it. So we have this whole system set up to achieve your goals. So you identified your goals. We got down to the tactical level of, okay, here's what I'm going to do. Here are the investments that are going to help me reach my goals. But we know it's always buy and hold, not buy and forget. And we know your portfolio over time is going to evolve, and investments that were once good aren't going to be good, and life happens. So there's two parts to monitoring your portfolio. The first is to simply review your portfolio and see, is something in your portfolio violating a sell rule? Is an investment that was once attractive no longer attractive? Or perhaps its characteristics have changed. Maybe you're a strong growth investor and this investment has suddenly stopped growing. Revenues have stopped growing. earnings growth has stagnated, and it's time to move on to another growth estimate. So you want to see, first of all, whether any investments you hold are violating a sell rule. And if so, then maybe it's time to part with those investments and find a new investment. Go back to step 4, selecting investment. Use your rules. But the other part is, has there something happened in your life or your family that warrants reviewing all your goals? And so there's 2 parts to it. So we're talking about investments. So if you're looking at mutual funds, we said Bob and Jane are using a 529 plan. When they're looking at mutual funds, they can consider types of things as, has the objective changed? If it's an actively managed fund, is the active manager still beating their peers, or are they now underperforming? Have the expenses got out of whack? Are they still acceptable? And obviously, have there been offering changes in the 529 plan, or perhaps there's something that's actually more attractive than what they currently own? And obviously, you want to make sure it's not modestly attractive, that there's actually a significant enough difference where it warrants the change. And so we create a portfolio review checklist. And checklists are really powerful tools because they remind you about what you need to actually look at. And so you can see on here, we're talking about just thinking about when do you need to review your portfolio. And when you review your portfolio, what are you looking for? Has there been something, meeting a sell rule? Has there been a change in your strategy? If you're looking at funds, again, you want to pay attention, has there been a change in the fund strategy? Life stage and family changes. This really matters. Has there been something big in your life? So for Bob and Jane, perhaps their health has kind of deteriorated. Perhaps, their wealth has changed. Maybe, something to their pension. Change in housing. And this could be a number of things. This could be you moving to a bigger house. Perhaps Bob and Jane, they have to move to a living facility. Or maybe they're blessed and all of a sudden they have a 3rd grandkid and they want to think about how can they help that 3rd grandchild as well. And so it's really thinking about what happened in your life. Positive, you ended up with a big raise or some other really positive, big increase in your wealth, or, a positive change to your family, a new addition, or something, that could potentially place a constraint on you, cause you to reevaluate your goals in terms of your not being able to meet some because there's been a change in your health or an unfortunate change in your job or your wealth. And if so, this really is a prompt for you to go through and consider, does that change your goals? And if it changed your goals, then it's a prompt to actually walk back through the whole PRISM process. So monitoring, you can almost think of 2 branches. One, what's happening with my portfolio? And secondly, what's happening with my life? And so portfolio, if something happens to my portfolio that causes me to make a change in my portfolio, either rebalancing or removing or replacing on investments, and life stages is really, do my goals need to be reassessed? And, I have some final thoughts here, and obviously I'm happy to take more questions, but I think one of the things about this is that PRISM is supposed to be a living document. This isn't supposed to be a process that you go through once and you're done and you look at it. It's as you evolve, as your life evolves, we design PRISM. We want your personal wealth building process to evolve with you. And as we said before, we really built this as a framework. So we're not telling you exactly how to invest. We're giving you the tools so you can actually create your own personal method, but you're at least on this wide path to achieve your goals. And again, if you have multiple goals, make sure you prioritize them and ask yourself, if push came to shove, what would take priority over another goal? And your top goals should always be the ones ultimately driving the big decisions concerning how you allocate your wealth. John, do you have additional questions I can address?
Sure. Well, first of all, taxes. I mean, someone brings up, really didn't talk much about tax implications. Is that a constraint? How do taxes come into the whole overall analysis and construction of one's portfolio, monitoring, and things like that?
And that really comes down to, it's a tactical decision. So it comes down to, it fits inside and outside of the portfolio. Taxes are constraints. So for instance, If you need to hold bonds outside tax-preferred accounts like an IRA or Roth IRA, then obviously your need to hold municipal bonds would be something that would be a constraint of yours when you're selecting investments. But then there's also a whole issue just in general in terms of taxes. You could argue that's part of your selection strategy in terms of the type of investments you have, in terms of the type of investment philosophy you do. But then outside the PRISM process, there's also this whole issue of asset location. It's almost an addendum to it, to where do you actually hold certain investments? Do you, for instance, it really to every investor's advantage to hold the investments that are most tax costly. Say, for instance, a real estate investment trust, which has distributions that are taxed as ordinary income. To the extent you can hold those in a tax-preferred account, that's your advantage. But that's a tactical decision, and that really is an asset location question that falls out of the boundaries of our main 5 steps of PRISM. But you could perhaps, again, consider them in terms of how you're picking investments, as what constraints you need to have. If you have certain goals, and certain goals that are, say, in a taxable account, and certain goals are going to be in a retirement account.
You know, a member here is asking about I-bonds, U.S. Treasury I-bonds. These are bonds, I think they're sold directly by the Treasury, and they are indexed to inflation. How would they fit into the overall asset allocation? Any comments on I-bonds?
Yeah, you know, it really is, it comes down to your fixed income allocation. And so I would put I-bonds into it. I've had people also ask me how their pension applies or Social Security applies in asset allocation. And I'll actually go back to Jack Bogle, and his thought was that you should really treat Social Security and pensions as a fixed income asset because you have those cash flows. So I think it all ties into it, that it is just a form of I-bond. It is a form of fixed incomes. And so that fits into your allocation. And so it really is that tactical approach of, when it comes down to selecting your investments, I-bonds might be how you want to actually use to fulfill that fixed income bucket of your asset allocation.
With interest rates so low, you know, do bonds make sense? Does one still create a bond ladder where you have, you know, let's say a 5-year ladder where things expire every 5 years, or do you stay short term? You know, the problem with short term is rates are so low. You know, how does one handle an environment like now where we've had this long secular decline in interest rates, but the fear of rising rates either nominally or even, you know, because of inflation going forward?
Sure, and there's two things to that. So first of all, there's that allocation, which depends on your risk, whether or not you need an allocation to bonds. And so that's driven by the risk tolerance portion of PRISM. But then in terms of the types of bonds, that really comes down to selecting investments. And you want to think about, in this case, the role bonds are playing in your portfolio. Is it a long-term buffer, or are you using it more in a tactical sense to provide maybe that short-term income? Now, if you do have a place for bonds, then it again comes down to selecting investments, that tactical approach, where you want to think about what you're looking for. And certainly when we talk about, if you're concerned about interest rates, laddering bonds, or if you don't want to hold individual bonds, laddering defined maturity bond funds, which are mutual funds that mature on certain dates, like bonds do, that's a tactical approach where you could actually use to maybe offset the risk of interest rates potentially rising in the future. So again, the tactical stuff really comes out selecting investments about how you're actually going to apply your allocation, where the selecting bonds is really comes out of your risk tolerance, and do you need bonds given your risk tolerance? How does that fit into your allocation needs?
And building on the asset allocation question here, so I think our asset allocation models only have, you know, they have large cap, mid cap, small cap, international, but there's no breakdown between growth versus value. Does that, you know, members asking, you know, should there be an allocation of growth versus value? And how does one member handle that?
Yeah, and I have a phrase for that. Allocation is very personal, and that really comes down to your preference as an investor. Do you have a preference for value? Do you have a preference for growth? I saw one study that suggests whether you're a value or you're a growth investor depends on just how you were born, and then partially on your upbringing. That some people have a natural tendencies to favor growth or value. So that really comes down to selecting investments. And do you have a personal preference towards one or the other? And you certainly could allocate to both. And that just really is a preference thing that we didn't really build into PRISM, because it really is a personal decision. It really is, when you're looking at how do you select investments, what is your personal preference? And the reason we didn't build in PRISM is there's just so many different flavors, so to speak, of investors: value, growth, technical, short-term, long-term, tactical, that it almost becomes unwieldy. And we don't want to give people so many choices that they get paralyzed by having too many options. We'd rather give them a broader framework which they can operate, and then they have the room to say, I'm a momentum investor, I'm a value investor, I use technical analysis, those type of things, and allow people to actually make those decisions themselves.
Okay, the key is probably try to make sure that it's evidence-based, that there's some theoretical logic behind the approach, and there's even a notion that some people want to have a behavioral element to it, so that there's a reason for this reason to pick stocks or pick an allocation will hold true over time. In terms of a question here that this member here read, that does it really make questioning, does it make sense for someone who is a retiree to be invested in international stocks? Is that too risky? Any comment on that?
Yeah, there's a lot of arguments about whether or not international stocks should be in there. I don't think it's really risky. I mean, you do obviously incur currency risk, but then if dollar weakens, it helps your international investments. Over time, they do actually provide diversification, so they can lower the risk of the portfolio. But it's important to realize that when we look at correlations of international stocks to U.S. stocks, the correlation is not static. So when things go down, everything seems to go down in the stock market. So you see the correlations. When you see international stocks tend to drop in unison with U.S. stocks, but when then the markets are doing well, you tend to see international stocks doing well sometimes. You see U.S. stocks doing well sometimes. So it does actually provide you with benefits, but there's also that comfort level. And if you really just don't feel comfortable investing in international stocks, then stay with domestic stocks, because a strategy you can stick with is always better than a strategy you can't stick with, no matter how appealing the returns of the strategy you can't stick with seem.
Yeah, this is in a whole different field, but I've always heard that the best camera you have is the one that's in your pocket or with you. So, I mean, you could have a great camera, but if it's not available for you to use it when you need it, it's of no use to you. And I guess a lot of questions came up here in regards to fiduciaries, how one picks an advisor, should they be an RRA, a registered investment advisor? Do we have any good resources that we could point to members that have that kind of question in mind?
Yeah, I'll get with Gina, our managing editor. She's the one who's responsible for making the journal look so good. She and Nina, our editors, do a great job in terms of editing. But I will get to Gene, and I will with the show notes, and we'll put some articles in there. We actually have a great article from an advisor who's worked in the industry for many decades, where he actually came up with 5 questions to ask a potential planner or advisor you're working with to see whether or not they're the right fit for you. So we'll do that, and we'll also include some of the resources I mentioned earlier, such as FINRA's broker check, and the SEC also has a tool you can use to check brokers and advisors as well. And again, I always equate to somehow if you move to a new area and you're trying to find a new doctor, it's always helpful to ask for recommendations from people you trust, and then obviously do your own background check to make sure that person is the right person, and that person is someone you really want to work with.
And Rick here says that NA, PFA, and XY planning networks are excellent resources for finding fee-only advisors, just as a shout out from Rick here. In terms of, I would like to have higher dividend rates versus interest rates? Are you better off having dividends from stocks for income, which have potentially being raised, or better off with fixed income?
Yeah, that really is a risk tolerance decision, and the question is, how much you're withdrawing relative to your wealth. So if the dividends are paying enough, that's all you need to withdraw is the dividends, and you do not need, and you have enough wealth where you can withstand the volatility in the markets. Obviously, over time, dividends are going to give you a higher cash flow. Bonds will give you more of a cushion. If your risk is a concern for you, particularly volatility in the market's going to potentially hurt your wealth, then you want to consider more allocations to bonds because you'll have more preservation of wealth. So, simple terms, stocks can give you growth of wealth, bonds can give you preservation of wealth, but that preservation of wealth does come at the potential shortfall of losing purchasing power or your ability to buy goods with the dollars you have.
Now, this is a specialized investment security type, but your asset allocation doesn't address specialty things like oil drilling partnerships, things like that have special tax elements tied to them. How do they fit into the overall allocation process?
Yeah, again, I'll go back to where allocations are very personal. So our models are just that, they're just models, and we show the returns for them on our website so people can see how they're doing. But what I will say is that, and I'm going to plug in, I thought this charger is not working here. What I will say though, in some of those investments, you want to consider what kind of investment they are, whether or not they are a equity type investment, or are they more of a fixed income type of investment, and that plays in to their allocation decisions. So MLPs, for instance, are a form of equity. REITs, which you don't have, are a form of equity. So you want to consider it in that context.
So Charles, I see you're running low on power there, so I'm going to ask you one last question here. Can you recommend a resource for developing well-defined buy and sell rules?
Yeah, we have a lot in actually the AAII Journal that we've done over the year into our stock analysis. But we are actually going to come with an article, like I said, in the issue in July. We're going to have actually address guidelines for picking mutual funds and ETFs. And the August issue, and we have planned right now is to actually talk about stocks. But I also encourage people to take a look at our portfolios as well. Our model shadow stock portfolio, our stock superstars portfolio, our dividend investing portfolio, our VMQ stocks portfolio. We all have guidelines there for how to actually pick stocks. And the other thing I'll call it's just our stock screens, where you can actually see for different styles, whether it's growth, whether it's momentum, whether it's dividends. You can look at the screens to see the discipline rules we use for actually selecting stocks. And the sell rules are really the opposite of those. So we have a lot of resources throughout AAII for how to do it. But just for a broader sense for about how you should go about trying to create rules, I will go back to the shadow stock portfolio, where over the years, Jim Cloonan spent a lot of time talking about his rules, how he developed them, the logic behind it, and it can actually give you a lot of inspiration for how you need to go about creating your own rules. But again, starting in July Journal, we'll start giving people guidelines for different types of investments.
And Charles, you're working on a special project with PRISM. In fact, you want to get our members involved and get some feedback. Is there anything you want to tell us about that before we lose you?
Yeah, absolutely. And I'm glad to say my computer's back to charging. New computer and the adapter wasn't quite working so right. But everyone who registered for this webinar will be getting an email within the next day or two. We're doing a special project involving PRISM, and we're looking for members who are willing to not only go through the process, but actually give us feedback. Let us know how the process worked for them. Let us know what they learned from it, how it actually, if it confirmed what they're doing, if it led them to make changes. And so we're really looking for investors, for a group of investors to give us feedback, and we're looking for a diverse set of members as well. So, people, I want to say we look for people who are young investors, maybe early in their career, investors who are in retirement, and investors in retirement. And the ultimate goal is to help use their experiences to help other investors see how PRISM can work and help them actually see how they can develop their own wealth-building process plan for them to achieve their own personal goals. And so keep an eye out. You'll be getting that invitation soon. We'll just bring you to a brief survey where you can say, yes, I'm interested. Here's my contact information.
Well, thank you. And again, great presentation, Charles. And tomorrow you'll be sending out an email with a lot of links to all these various worksheets that you provided and mentioned over the course of the night, links to the articles you've done in the journal, and even telling members where they can go to help analyze a advisor and also how to do a broker check. So those are all things that you and Jean are gonna, not only you're gonna put the July journal to bed, but you're also gonna get out that email. So thank you very much for the presentation tonight. I really enjoyed it. Our members enjoyed it. I got some great feedback here from members. A lot of thank yous are coming up. So, and one member is relieved that it's your computer that's low on power. He was afraid it was his for a second there when he saw the message. So thank you very much, Charles.
Yeah.
I guess with that, I guess we'll throw the baton over to Kyler.
Thank you, John. And then thank you, Charles. That was an amazing presentation, as always. I want to thank everyone for attending tonight's webinar. Links to some of the resources discussed tonight will be sent to your email addresses. We do have upcoming webinars to highlight, which you can sign up for at aaii.com/webinars. The first is the Individual Investor Show, Picking Right Investments, First Cut Large Growth Funds, and Convertibles, which will be on Wednesday, June 23rd at 7:30 p.m. And the next one will be on June 30th. It's a rebroadcast of the Unveiling AAII's Platinum Service webinar. It's going to be at 12 p.m. Central Standard Time, so which is different from the normal broadcast time of 7:30. So be on the lookout for that. We wish all of you viewing good health, good fortune, and a great evening. Thank you.
Thank you.